Welcome to Blue Dirt, the podcast that digs deep into the foundation of commercial real estate investing. Unlike most real estate shows that focus on deal making and market trends, Blue Dirt gets into the nuts and bolts of what truly builds long-term value, the building itself. We break down how to spot deferred maintenance before it costs you, why a solid preventative maintenance program is a game changer, and how triple net leases can maximize your investment returns. We'll also explore the importance of strong landlord-tenant relationships and how they drive stability and growth in your portfolio. Whether you're a seasoned investor or just getting started, Blue Dirt gives you the practical knowledge to make smarter, more profitable decisions in commercial real estate. It's time to get your hands dirty and build value from the ground up. Let's dig in. Welcome to the Blue Dirt Podcast, where even idiots can make a killing in commercial real estate. Today's questions that we're hoping to answer are: 1, when is the best time to invest in commercial real estate? 2, how do the current interest rates affect our decision-making process? And what can I do to properly prepare for my next investment? So, Don,
I don't know if we'll get through all three, but we'll try.
What's the best time to invest?
My motto is today. Just start today. It's probably not the right answer, but I like it.
So let's talk about psychology for a second before we dive into the question. Over the years, I've ran into a lot of people, and a lot of times what you always hear is, man, if I would have invested back then, I would, it's everybody operates in the rearview mirror. But if you look at the history of real estate over a long period of time, it has always seemed to gone up. Have there been a couple blips? Yes. But we are a price per square foot buyers. So we typically buy opportunities. And so if the market does drop, it typically doesn't drop below what we're buying things for. But everybody focuses on, man, oh man, if we would have bought that corner back then, and I'm going to tell you, stop looking in the rearview mirror. You can look at it from a historical perspective, but focus on the here and now. And I think Don, to some degree, is right. It's always a good time to buy commercial real estate. The question is, are you buying the right asset? Okay. And are you paying the right price? It's always the right time, but it doesn't mean it's the right price, the right location, or the right asset. Okay. So that's where preparing yourself for the acquisition process is important. So when is the right time? Well, take yourself, for instance. So if you were going to invest, number one, are you prepared? Number one, financially. Are you prepared time-wise? If you're the type of person that wants to purchase and then put all of the sweat equity into the property, do you have the time? Do you have the support from your family? Can you get away from the kids and the wife to go do this work? Are they involved with you? Are they supporting you? All right. If you're the woman, is your husband supporting you? I mean, it doesn't really matter who you are, but the time has to depend on what you are looking to put in. Don, it's his full-time job. So Don, if we buy a property, okay, we're working on a property right now.
Yeah.
Let's take that restaurant we're about to buy. Mm-hmm. What type of time is... Now that one's a little different because that one seems to be in pretty good condition. So usually we buy real big problem children. This one, yeah. But everything has issues.
Yeah, it does seem like it had some issues. They've done some maybe expansion a little bit to the footprint of the building, and however they tied it in wasn't proper. But overall, we just finished doing a lot of the inspections that we've talked about in the past, right? We've gotten the sewer lines.
Forget the past. If somebody's listening to this podcast for the first time, what inspections have you already done?
So what we've done so far was mechanical, electrical, and plumbing. We're just waiting on the roof now.
Right.
If we see something that's of concern that looks even a little bit concerning or maybe sometimes even out of caution, depending on the size of the investment, we'll bring in the structural engineer just to look and consult. But overall, we've got those three complete and just waiting on the roof, and all have come back overly positive. And let me clarify, they've come back very positive relative to everything else that we usually buy. Okay. Yeah, because we just accept that we have to.
So let's assume that you were buying this by yourself and you had a full-time job doing something outside of real estate, what time and effort would you need to put into this property away from your family?
I don't think this one would take very much time, to be honest.
Well, would you paint it? Would you clean it up? What would you do? I mean, while it may not need those significant investments, you still would want to do certain things.
I would clean it. That's one thing that it helps potential tenants really visualize what they're trying. And it's always a line that you walk, right? You can get in there and do a bunch of stuff. You could paint it, but you may paint it and their brand is a different color, right? They may want something totally different, a totally different vibe. So you're always walking that line of, do I improve it or do I save that money and potentially offer it as TI to a new tenant, or say, hey, I'm going to paint it, when we're showing it. Hey, just so you guys know, I'm going to paint the property, but I'm waiting for a new tenant to confirm what color I'm going to go with. And of course, we'll put parameters on that. But a lot of times you're walking those lines. With this one, I just get in and clean it up, and that's easy. I mean, we could get the grandma to watch the kids for a few hours. The wife goes there, I go there, roll up your sleeves, just clean it, and just so it shows well.
Right.
That's really what you're trying to get the biggest thing accomplished, because all the other stuff is relatively fine as it is.
Right. And so then the timing has to do with, okay, well, when you're modeling out this investment, you have to assume that you're going to have a certain amount of vacancy. So in this case, this is a restaurant and lounge. When we model things out, we are ultra conservative. So this is something that I always recommend is don't try to fool yourself, because you'll fool yourself into bankruptcy. So if you believe that, and you need to understand what the market rate is, if you believe the market rate for this type of asset in this location, I believe it's probably $15 to $18 a square foot. I'm going to model this at $12 a square foot, right? So I'm going to model it below market, okay? And then I'm going to assume that it sits vacant for 6 months. And actually the way I modeled it was I can separate the building into two. So I'm going to lease up half the building in 6 months and the other half in 12 months, okay? And then even though I think I'll be 100% full in 12 months, I always keep 10% vacancy throughout the remaining term in my modeling process. And then we use the CCIM discounted cash flow analysis. So I buy day one of year one and I sell day one of year 6. So it's a 5-year hold. And then I predict the sales price. So during that modeling, this is where you have to be very disciplined. And we look for a 20% internal rate of return after tax. Well, I like it after tax, right? So that's, and why do we need that? And I've explained, and I will always explain this over and over, because if I miss, then we're probably still in the double digits. And if I completely screw up, we're still probably getting a positive return in the single digits, right? What I never want is to lose money. You don't want to lose money. I don't want to lose money. So don't fool yourself just because you can manipulate things and give it to maybe your lender and they'll buy it. That doesn't work. It doesn't matter. You want your lender to be your partner. And so don't model things in a way that is really difficult to attain. You want layups, because if you hit it right on the first one, then you'll do the next one right. You'll do the next, and then 20 down the road, you have all successes, and that's what you want. So,
yeah. And the part too, that shouldn't really be glazed over at all is that price per square foot. Yeah. If you're modeling it at 15 or 18, right, that it's going to do wildly successful, but it still makes money at 12. It's so important, because if you get into the next down cycle and you can drop your rate down to the $12 a square foot, if it's vacant, and you're still making money, and you can beat out everybody else in the market because you have the space that someone can afford to slide into, you can weather the storm, and get through that downturn. You may linger a little bit past it, but you made it through with this asset still producing some money, or at least worst case, paying for itself and not costing you money to where you can retain it, get through the storm, and then come out the other side and then, increase rents hopefully with another tenant.
So the best time is, I do believe it's now, but I believe it's always now for me and for Don. But you still have to be extremely disciplined on what you're paying, what you're buying, and the market conditions. You have to always be ready for that. Now, how do the current interest rates affect your decision making? Well, during the modeling we just mentioned, using the discounted cash flow analysis, we're going to put in the terms of the loan. And if it's going to still produce a certain return on investment. And if it meets your metric, whether the interest rates are 3% or 8%, if it still spits out the positive cash flow that hits your mark, then you do the deal. The deal we did a couple of years ago, we had one loan that was 8%. We have a whole bunch of loans at 4%. It doesn't matter to me what the interest rates are. If it pencils during my modeling, I buy the property. So I don't care about that, right? Now, do we want free money at the 4 and 4.5%? Well, of course we do. Who doesn't? But the reality of it is it's not going to stop us from buying if we can still get the desired return on investment.
Yeah. I mean, they had to live through that in the late 80s, right? High interest rates, extremely high interest rates. And you get through that, they're still making deals happen, still having things work, but you may have to sharpen your pencil a little bit. You may have to get a bit more creative. But there's always deals. There's always deals.
And high interest rates, or higher. Let me just tell you, the deal that we're talking about buying right now, we're getting at 6.25. I'm pretty happy about that. The other deal that we're buying up the street here, 6.43%. I'm happy with that. I don't worry about tenths of a percentage. I mean, don't get me wrong. You always want it to be less. Who doesn't? But the reality of it is some properties as investors, we're harder to underwrite. And so I'm just grateful that we have a lot of bankers that we consider good partners for us. And so that's my take on interest rates. Anything else on that, Don?
No, that's
okay. So what can I do? In this case, what can you do to prepare for your next purchase? A ton. You should be preparing every day and research.
Yeah.
Talk about research. Don does it all the time.
That's probably, there's one part to it that is I think really the most important part, which sounds like it doesn't make sense, is on the surface, you're looking at these deals and you're kind of comparing, the price to purchase, what the current market is if I was going to release it. And you're trying to pencil all these deals. What you really need to be doing is just looking at vast quantities of these deals and getting just more familiar. I'm going to say on a almost like a macro set. Because if you look at 200 properties over the course of a month and you don't pull the trigger, if you look at another 200 the next month, you're going to get a lot more comfortable because you're seeing the trends, you're seeing kind of how the market's unfolding, and you're just learning. You're really learning what's happening in the market for that type of maybe asset class or the location or all this stuff. Just keep looking at it as a source of interest and education, and you'll be able to see where the deals are. Right. They'll start showing up. Oh my God, I can't believe that's that price. That's phenomenal. I just looked at 200 retail centers last month and they were all double. And this one looks great. It's at least enough for you to dive in a little deeper.
Right. So looks at properties, and what Don's really articulating is you're gaining market intelligence. All right. So you need to understand the properties and the price per square foot that they're being sold for. And you need to look at those same like properties and what they're leasing for. And there's a lot of variables because one location should be higher and one location should be lower based on supply and demand, traffic generators, traffic counts, a lot of factors, density, demographics, There's a lot of factors. So just because you see something for $150 a square foot and then something else for $75 a square foot, the 150 still might be the better deal. So it's important that you understand a lot of other factors. Now we're price per square foot buyers. And so if I see something that, let's say the warehouses right now are on average $100 a square foot. Well, if I see something at $50 or $60 a square foot, it's number one, it's going to raise my eyebrows. I want to see what's going on with that. Okay. Number two, many times it's in a slightly degraded area. Okay. All right. Well, so that would justify a devaluation in a price per square foot, but maybe the devaluation should only be 90. Mm-hmm. Right. And so if I don't understand all of these data points, then I'm not going to understand a good deal if it bit me in the butt. Okay. So that's what Don's talking about. You got to get a lot of looks on these properties. Also, if a property, a warehouse in this area is leasing up at $10 a square foot and we see them selling at $100, and in this area, it's $8 a square foot, but selling at $60 a square foot. Well, this ROI might be a lot better, right? $8 a square foot on $60 is actually better than $10 a square foot on $100. So you have to understand both the sale and the lease for it to really make sense and bring it home. And then of course, then you have the demand based on areas, because certainly distribution points along interstates and highways might be better suited than a location that's in a residential neighborhood. So there's a lot of factors, but that's why when you say, take a look at 200 properties, you have to, over time, it'll become this intuition. And we are very fortunate because this is the space we work in. So we're seeing properties every single day. And I think that's our biggest advantage.
Yeah. And something a little bit related, but I love looking at kind of the random things too, that you may find where someone really didn't know what they were doing when they were listing it. Yeah. You can go on Facebook, you can go on, you can check land, and they may have a building on there that they're attributing no value to. And you can go in these other areas and you'll find these deals that are not triggering anyone's searches because they're just
talk about our one property.
The land. So where they had it as that. Yeah. There
may as well talk about it because this is one of my, this is brilliant.
So they had marketed it. Was it 10 years?
10 years.
It was on the market. So this piece of land was in an area where it really had no value, but they were trying to use it as residential, if I'm not mistaken. They were saying, hey, buy this larger parcel.
It was about 4 acres.
Yep. In a close to downtown, right? But it was like looking at it, and I look at it on the map and I'm like, there's a building there. So, kind of run some back of the envelope math. I'm like, okay, based on what they're trying to sell it for, the land, this is a phenomenal deal for this building. And got over there. Roof was actually in pretty good shape. It needed a lot of extra work, but it was mislabeled. I'm sure we'll dive into this one more on a deep dive one, but that just shows you.
Just to clarify, it was not mislabeled. It's just that this broker did not attribute any value to the building.
That's fair.
So they were marketing it as purely 4 acres of land for about $300,000. It had a 12,000 square foot building on it that was a piece of dung. But Don and I love those types of assets. So we get it under contract at $250,000. We put another 160. We have about $400,000 into the property after renovation. We had just put it on the market for lease. So now we have $400,000 into it. We've owned it for about 4 months, and we get an offer and decide to sell it for $760,000 in less than 6 months.
Yeah. I mean, we were finishing the construction as it was closing.
Right.
It was that.
And so it was one of those random things that, now, again, we weren't planning on flipping it because we really liked the asset, and we don't flip many properties. In fact, we had paid extra to get a 10-year term. But when we got this offer, we're like, well, golly, we can turn around and make a good lick here And then we sold it. So this property was on the market for 10 years. Everybody had seen it. We hadn't seen it because it was kind of in this residential neighborhood, but it was only one block off of a main street, and it really worked out well. And the guy who bought it had a perfect use for it, and he's really maximizing that asset. So it was really worth it for him. It was really worth it for us. We took that profit and actually bought 2 properties. I know we brought 415, right?
Yep.
And then we brought Maxwell.
Correct.
So we took this profit and bought 2 other properties, paid cash for them. So now we own these other 2 properties debt free. So, it's just a little monopoly and having a good time with it. So how can you prepare for the deal, review the market, look at properties, clean up your personal financial situation? Okay. Because you're going to have to go to a lender or even to a partner and ask for money in all likelihood, unless you're going to pay cash. Right. And so get rid of these randomness and be disciplined. Don't live beyond your means. You want to live beyond your means? Be disciplined now. Enjoy saving money so you can then invest it into this passive income that you're going to try to make. Because that's what we're all working here for, is we're working for passive income. So I go to work every day, work my tail off at my day job, which is being a commercial real estate agent for other people. And then the money that I make from my commissions, I then invest into commercial real estate. Don goes to work every single day as a property manager for commercial real estate. And then he takes the money that he makes and he invests into real estate as well. So don't quit your day job. Lean into your day job, but make sure you take that money and you save it. Okay? So clean up your personal financial situation. Also, pay your bills. Pay your bills, pay them on time, pay them quick. Don't carry credit card balances. Pay your stuff off. Be financially responsible. I know that's tough for a lot of people. Everybody wants everything to be get rich quick. I'm telling you, we don't deal with get rich quick. We deal with get rich over time. And I'm going to tell you, you don't have to be highly intelligent. I'm an idiot. Don's an idiot. And we're making a killing in commercial real estate. All right. If you like partners, I love partners personally. Now, I don't seek blind money. I like to bring in my best friends into the deals, and I really enjoy the camaraderie. And why do I do that? Because to me, it's fun. Everything I do is relationship driven. I love having Donna as my partner. I love having my best friends as my partners. So, and we all put our own money into these deals. And so it's relationship. So if you are the type of person that enjoys having partners, well, then start lining up these partners in advance and make sure that you guys build a model together. But when you build these relationships for investing, make sure your goals are aligned. If you are the type of person that wants to invest for long-term investing, don't go and bring on an investor that expects you to flip the property in 6 months. Okay. If your goals aren't aligned, it doesn't mean that they're right and you're wrong, or you're right and they're wrong. You just have to have alignment in your goals. That's all. So make sure whatever your goals are, it's aligned with what your partner's goals are. Okay. Especially if you're the one who's going to be doing the work, you have to be in alignment. Okay.
Yeah. And don't be afraid to share that. Some people want to get a little sheepish, when it comes to it. It is a lot better just to go, full open book, right then, and show, hey, this is how I'm viewing this process. So I'm viewing investing. This is what I plan to do. Don't get into this and then have to figure a way out of it, in a year when your goals aren't aligned. Just fall on the table, let it all there. Is definitely beneficial.
One more thing on that. I'm glad you mentioned that. If you bring on a partner that this is all the money that they have, that's probably not the right partner. And the reason why I say that is because if this does not produce the return on investment in the timeline that you expect, you don't want them coming to you saying, oh, you got to buy me out. You got to buy me out. Bring on a partner that can afford to be patient in time. I think I mentioned it before that, our average investment starts to pay back by the end of the 3rd year. And then from that point forward, it typically pays something every year, right? we still work every day. So we don't need this money to pay our bills. Okay. So if you find an investor that needs this money to pay their bills, that you may not want to have them as an investor. Okay. Make sure that the money that they give you is something that they can live without. Okay. Also, hopefully they have more in the tank, because on occasion, you need to go back to them for a capital call. Let's say you begin your renovation and you discover something that takes more capital. Well, if you didn't raise enough on the initial raise, then you have to go back and do what's called a capital call, where you go back to your partners and say, hey, listen, we need to do another capital call for $20,000, $50,000, $100,000. You need to put in your pro rata share. And if they don't have the money, then your operating agreement will have clauses in there, but that's not what you want, right? You need to invite people into your deal that can afford to invest, and they don't need that money right away. Okay. Anything to add on that?
There's probably a lot. I mean, another one that comes to mind is, you can go to people who will, as you begin this kind of journey, as you're looking at things, they're all about, hey, yeah, let me know. I want to give you money. I want to give you money.
Right.
And then when it comes down to it, it's okay. Hey, I got this under contract, and this is what the points, this is the price per point. How many do you want? Now's not a good time. It's that. So I would say probably have more partners that you're looking to go to than you need, or you think you initially are going to have.
Well, I tell you,
all the time.
I've got, I think, over 40 deals under my belt, and I'm very fortunate that I've never had to go to somebody that didn't come to me first. The only people I ever call are people that reached out to me and said, hey, listen, I really want to invest with you. And when I select a property or get a property under contract, I kind of look at the property and say, who do I think would be a good investor for this asset class? I could have a partner over here that is a partner of mine in 5 properties that I don't think would enjoy this asset class. So a lot of times I just kind of decide and I say, I typically invite one other high net worth investor, maybe 2, depending on the asset. And then many times I'll invite my team in my office, who then might take, who may not have as much money, but they might take 1, 2, 3, 5 points on a deal. And, but they wouldn't otherwise have the opportunity to invest. And they're not on the bank note. They're not personally guaranteeing. The personal guarantee is what I do. But then that allows everybody to share in ownership and share in the pride of ownership. Now, I'm fortunate in what I was going to say is, if I select, in my mind, these 2 people, I pick up the phone. Now, I don't know if I'm a jerk, but if they say no, they're probably not getting another call. And to Don's point, I've had people say, yeah. And so I give them a call. Oh, no, it's not a good time. They're off the list. Okay. Because if I have orchestrated in my mind that I think you're the right fit, or I want to give you an opportunity, I don't need your money. I do it because I love relationship with other people, and I really enjoy that process. So to me, it's really fun. And because at the end of each year, Don and I put together a big partner meeting. We celebrate that evening. So we have people that come in and fly in from out of town. We have a big celebratory day where we do all the financial review, and then we go and have a wonderful dinner, and we break bread and really just enjoy each other. And I mean, my best friends from childhood are involved in these deals, and I love that. I love the fact that they can come in and share in all the in the investments. And then sometimes we'll just kind of go around and tour the properties. And some of these guys have never even seen the properties that they've invested in. And now, listen, most of my partners on properties, it's 1 or 2 of us. Okay, so it's not like it's offered to 50 people. So we may own, 2 of us will typically own 80 to 90%. And then if we offer it up to the whole team, they might take 10 to 20%. But the 80 to 90% we're on the loan. And so all that to be said is, make sure you find partners that are in alignment. And if you're new to this, like Don said, you might have to line up 3 or 4 people because the timing for them may not be right. And so you might have to make several calls to get that money.
6 or 7.
6 or 7. Okay.
Yeah,
And
err on the side of caution.
And then the last thing I wanted to talk about is banking relationships. So, and you'll hear this throughout all the podcasts when we talk about banking. Your favorite banker does not guarantee that they're going to give you that loan. While they might have a lot of loyalty to you as an individual, they have things within their bank that may not allow them to give you a loan on that particular asset or at this particular time. So you need to have a good stable of bankers. And what I do for my clients is I will make an introductory email to 8 to 10 different bankers, giving the banker a breakdown of the asset that's under contract, what type of loan and the terms that the client is looking for. And then I say, contact them directly. I just make an introduction. I don't need to be a part of their back and forth. But I needed to caution my client as well as you is you're going to get a lot of rejection from lenders. That's okay. I tell everybody I love a fast no. You just need to get to 1 or 2 good yeses to get this across the finish line. So don't be depressed when you get 5 or 6 quick no's that, and you might tend to take it personally. I get no's all the time. I don't care, So just make sure your balance sheet is cleaned up. Make sure you get rid of all the riffraff on there. Pay your bills. Make sure you're always working to improve your credit. Don't spend money that you don't have. Don't waste money on things you don't need. The only thing you need is commercial real estate in your portfolio for the long-term passive income.
Yeah. I was going to say, what was I going to say? I'm going to go back to
I'm on the edge of my seat right now.
Oh, it was when you're talking about the lenders and getting the no's quickly. And just one thing that it just had stuck out because I'd heard it so many times, when you're talking to somebody, an outside client who may have something under contract, and they do that. They reach out to their friend who they've known, their banker, and they'll get the no, and they go into a dark place. Psychologically, they're depressed. They're done. Their dreams are to a degree, squashed right then. And I remember hearing you follow up with them a few times. A few different people follow up with them after a couple of weeks. Hey, how's it going? No, I can't do it. I got declined. Oh, okay. So you got declined by 1, but how many? Well, that was the only one. Don't stop there. Just keep going. There's, like you said, it's beyond their control. It has to fit into their diversified portfolio of the bank and how they have their metrics lined out for the upcoming future. So don't let that know. Don't let the no's of the people that you may call who you believe will be the initial partners. Luck favors the prepared. So get your financial house in order, and then just be prepared to get told no a lot by everybody all the time.
No's are good. Well, that wraps up another episode of the Blue Dirt Podcast, where even idiots can make a killing in commercial real estate. That's a wrap for this episode of Blue Dirt. We're here to help you build smarter, invest wiser, and create long-term value in commercial real estate, one solid foundation at a time. If you found today's insights useful, be sure to subscribe so you never miss an episode. And if you know somebody who could benefit from these discussions, share Blue Dirt with them. Got questions or topics you'd like us to cover? Reach out. We'd love to hear from you. Until next time, keep digging deep, stay sharp, and remember, real value is built from the ground up. See you on the next episode.